Picture two men, same age, same zip code, both staring at a $50,000 bank balance and pulling down a $55,000 paycheck. One signs the paperwork on a rental house. The other quietly funnels every dollar into a basic index fund. Fast forward 2 decades, and one of them has built serious wealth. The other one has too, except he grinded twice as long, swallowed 5 times more risk, and burned through more weekends than he can count putting out. Fires he never saw coming. And that's the trap baked into every real estate versus stocks argument floating around online. The verdict is usually decided before a single calculator gets opened. The landlord crowd preaches cash flow as the holy grail. The index fund crowd worships at the altar of compounding. Both are telling you something true. Both are also conveniently skipping the parts that would weaken their own pitch. This video isn't here to crown a champion. It's here to put every single number on the table, honestly. The flashy stats people slap on thumbnails, and the ugly ones tucked into the fine print no one reads. By the time we wrap up, you'll see which path actually pulled ahead, why the real answer refuses to fit on a bumper sticker, and how this math plays out for the situation you're actually living in. Quick housekeeping before we dive in. If straightforward, no-spin breakdowns are your thing, smash that subscribe button. This channel exists to dismantle financial topics fully. Real numbers, no sales pitch. Subscribe and flip on notifications so nothing slips past you. Meet Jake and Marcus. Both 30 years old, both sitting on $50,000. Same town, same paycheck, identical launch pad. The single thing separating them? What that 50 grand becomes. Jake puts his cash down as the 20%. Deposit on a $250,000 rental. 3 bedrooms, respectable street, nothing flashy. He locks in a 30-year mortgage at 7%. The bank wants $2,330 from him every month. He signs a tenant who agrees to pay $1,800. On paper, that's $470 a month landing in his pocket before any expenses. Jake walks around feeling like he just cracked a code. He brings it up at parties, takes the long way home so he can roll past his property, and quietly thinks, that's mine. Marcus takes his identical $50,000 and dumps it into a total stock market index fund. No debt, no renters, no keychain, no good story for a first date. He schedules an automatic $300 transfer every month and basically forgets the account exists. When colleagues ask him where his money is, he mumbles something about index funds. They smile, change the subject, and move on. Nobody's writing home about it. Day one for Marcus is a confirmation email and a login screen. That's the entire empire. And right here is the piece almost nobody addresses in this debate. The emotional reality of these two paths is night and day. Jake's investment you can drive past and touch. Marcus's investment is a number on a phone. Jake's makes him feel like a player. Marcus's makes him feel like he's doing nothing. That gap, that feeling of doing something versus doing nothing, will quietly steer every financial choice both of them make for the next 20 years. And as we'll find out, emotions carry a price tag. 12 months in, Jake is genuinely loving the landlord chapter. Rent shows up like clockwork. Come tax season, he's writing off mortgage interest and depreciation. Every payment chips a little more equity off the loan. The neighborhood is heating up. Everything looks, smells, and behaves exactly like the YouTube tutorials promised. Marcus, by contrast, peaks at his account maybe 4 times a year. End of year 1, his $50,000 has crept up to around $55,000. End of year 2, maybe $61,000. There's no drama, no narrative. Just a number that wiggles slightly upward, occasionally dips, then climbs again. Now let's drag the calculator out and run year 3, because this is where the highlight reel collides with reality. Jake has pulled in $800 in rent over those 36 months. His mortgage payments have eaten up, $47,080, so gross cash flow comes to $16,920. Beautiful number. The kind of figure that ends up in a thumbnail or gets bragged about at a backyard barbecue. Now watch what gets carved out of that. $16,920 before Jake sees a single dollar. Property taxes around $3,000 annually, so $9,000 across 3 years. Insurance, $500 a year, another $4,500. Year 2, the water heater dies. $1,200. Year 3, the roof springs a leak. $2,800. There's a 1-month gap between renters, costing him $1,800 in lost rent plus $600 to advertise the unit. Jake handles management himself to keep costs down, which translates to weekend showings, late-night texts about clogged toilets, and squeezing repair calls into his lunch break. None of those hours get reimbursed. Once the actual receipts are tallied, Jake's true take-home over 3 years is somewhere between $2,000 and $4,000. Not the headline, $16,920. $2,000 to $4,000 on a $50,000 stake, And that's before anyone factors in his time. Marcus, meanwhile, has piled $50,000 plus another doll, $10,800 in monthly drips into the market. Assuming the long-run 10% historical average for total market funds, his account is sitting around $76,000. Hours of work logged, 0. Phone calls fielded, 0. Crises managed, 0. But here's what Marcus is missing that Jake is using. Leverage. Jake stretched $50,000 into command of a $250,000 asset. After 3 years of 3–4% appreciation, that house is now worth around $270,000 to $280,000. His equity has climbed to roughly $55,000 to $65,000. That's genuine wealth, and a huge slice of it was built using money he borrowed. That 5-to-1 multiplier is the single sharpest weapon real estate brings to the table, and it's why this contest never resolves as cleanly as either side wants you to believe. If this rundown is already showing you angles the standard real estate versus stocks video gloss is over, hit the like button. It boosts the algorithm and costs you about a heartbeat. Back to the math. Time to address the real estate expenses that mysteriously vanish from most YouTube comparisons. Vacancy. The typical rental sits empty about a month each year. That's a full mortgage check going out with nothing coming in. Every tenant turnover triggers cleaning bills, paint touch-ups, listing fees, and your own labor. Maintenance and repairs. Plan on 1–2% of the home's value each year. On a $250,000 property, that's $2,500 to $5,000 annually. Some years it's a $200 leaky tap. Other years it's a $7,000 AC system you can't postpone because it's 95 degrees and your tenant is one heat wave away from breaking the lease. Capital expenditures. Roofs tap out around 20–25 years. Furnaces, Kinsty 20. Water heaters, 10–12. These aren't possibilities. They're invoices waiting in the mail, and they show up in $5,000 to $15,000 chunks. If you're not stashing money each month for those eventualities, you're not investing. You're gambling, and the dealer always collects eventually. Property management. Hire it out and watch 8–10% of your rent disappear, somewhere around $150 to $180 a month. Skip the manager, and you've just signed up for a part-time job with no paycheck. Problem tenants. One renter who stops paying and learns how slowly eviction courts move can drain you of 3 to 6 months of rent plus attorney bills. A single bad case can wipe out an entire year of profit, and it lands on landlords from every experience bracket, rookies and veterans alike. None of these line items live inside that pretty 470 monthly cash flow figure. Every single one of them lives inside the actual checkbook. By year 5, Jake has graduated from landlord fantasy into landlord reality. Tenant number 3 is in the building. He's eaten an $8,500 roof replacement, a $2,400 plumbing crisis, and another month of empty unit. His real cash-on-cash yield, after the genuine bills, is hovering somewhere in the 3–5% zone. Not bad, but a far cry from the 15–20% he was selling to his buddies. Marcus is essentially still on autopilot. Around year 7, his portfolio, with steady $300 monthly drops, sits between $135,000 and $150,000. He never picked a single ticker. He never tried to outsmart the market. He just refused to flinch. Compounding has finally hit second gear. The growth on his existing growth is now generating more new dollars per year than his contributions ever did. Hit year 10, Jake's property has appreciated to roughly $335,000 to $350,000. The mortgage balance has come down to around $166,000. Equity, somewhere between $170,000 and $184,000. His total out-of-pocket, beyond that initial down payment, has run him another $20,000 to $40,000 over the decade. Marcus, with his consistent $300 contributions, is sitting on $165,000 to $180,000. His total deposits add up to $86,000. The rest? Pure compounding doing the heavy lifting. 0 Saturdays sacrificed to a paint roller. At the 10-year mark, the gap between them is shockingly slim. Jake might be edging ahead because of leverage, but Jake also burned hundreds of hours, took on $200,000 of debt, and parked his entire investment inside one address on one street in one city. Marcus is spread across thousands of public companies and hasn't lost a single hour of sleep. The 20-year figures are around the corner, and they're going to surprise you, especially what happens when one tiny variable in Marcus's playbook gets adjusted. Make sure you're subscribed so you don't miss the follow-up, where we model what unfolds when both strategies are run side by side. Hit that subscribe button, and let's keep moving. 20 years in, Jake's house is appraising somewhere between $450,000 and $500,000. The mortgage is either gone or whispering its last few payments. His equity now sits between $400,000 and $500,000 after 2 decades of leaks, evictions, paint jobs, taxes, and insurance bills. The cumulative cash flow profit, what he actually pocketed beyond what he put in, lands somewhere between $50,000 and $90,000. Marcus's portfolio, riding that 10% historical average with his consistent $300 monthly habit, has ballooned to roughly $420,000 to $460,000. His total deposits over 20 years, $122,000. The rest, more than $300,000, is compounding doing what compounding does. No mortgage, no renters, no panicked midnight texts about a flooding bathroom. At the 2-decade mark, both men are landing in the same neighborhood, somewhere between $400,000 and $500,000. But the road that got them there couldn't look more different. Jake earned his with sweat. Marcus earned his with patience. Now here's the lever that flips the entire equation. If Marcus had simply bumped his monthly investment by $200, going from $300 to $500, his 20-year balance jumps to roughly $550,000 to $600,000. In the index fund world, scaling up your contribution multiplies through compounding. In real estate, scaling up usually means closing on a second property, signing a second mortgage, and doubling your headache count overnight. But fairness cuts both ways, and if this video only beat up on real estate, it would be doing the exact thing every stock market guru does on the other side. Volatility is no joke. In 2008, the total market shed roughly 37%. March 2020 wiped out 34% in 4 weeks. If Marcus had been watching, $150,000 melt down to $95,000 in a single month. That's stomach-dropping territory. And the data is clear. Most everyday investors bail during the bottom and tiptoe back in after the rebound, cementing losses at the exact wrong moment. The strategy delivers if you white-knuckle through every storm. Most people can't. There's no income stream. Index funds don't mail you a check on the first of the month. A total market fund yields somewhere around 1.52%. On $150,000, that's about $200 a month. Not exactly a paycheck replacement. There's no leverage. Marcus used $50,000 to own $50,000 in assets. Jake used $50,000 to own $250,000 in assets. That 5-to-1 amplifier is precisely why real estate produces more millionaires than the stock market in nearly every wealth survey out there. And there's no depreciation. Real estate owners are legally allowed to write off the imaginary aging of their building against taxable income, even while the property's market value is climbing. That's a tax loophole the index fund crowd simply does not get to play. If this is hitting differently than the cookie-cutter takes you usually see, smack the like button. 1 second of effort, and it pushes this video to people who genuinely need to see it. And if you're new here, subscribe. Real estate wins decisively under specific conditions. If you're in a market where rent comes in at 0.8% to 1% of the purchase price, the math works on the day you close. If you operate it like a real business, vetting tenants thoroughly, reserving cash for CapEx, building repeatable systems, your returns can eclipse the market. If you house hack, living in one unit while renting the rest, you can drop your housing costs near zero while quietly stacking equity. And if you know how to wield a 1031 exchange, deferring capital gains by rolling profits into the next deal, you can grow in ways no stock investor can imitate. Real estate isn't a flawed asset. It's a precision instrument that performs spectacularly under conditions most buyers never confirm before signing. So here's the unvarnished verdict. If you've got boots on the ground market knowledge, bandwidth to manage a property, the stomach for illiquidity and surprise bills, and access to an area where the rent-to-price ratio actually pencils out, real estate can mint wealth that index funds can't touch. If you want simplicity, broad diversification, liquidity, no management hours, and the ability to scale without adding chaos, index fund investing will deliver wealth in the same league or higher with a fraction of the headache. And if you can run both engines at once, owning rentals in a workable market while feeding index funds every month, the combined math rewrites the entire playbook. That's the next video. But before you scroll away, here's the question that matters more than which side wins on paper. Did you actually count everything? Because the answer that includes every cost, every hour, every emotion is the only answer worth trusting. If this video handed you a sharper view of how these two investments stack up, not the highlight reel version, but the actual one, please tap like before you go. It genuinely lifts this content into more feeds. Subscribe for weekly deep dives that pull financial topics apart completely. with honest math and zero agenda. And leave a comment. Are you team real estate, team stocks, or running both at once? I respond to everyone. Catch you in the next one.